The best company doesn't always win. Smart investors often jump in early, but sometimes they get it wrong. When everyone agrees on who the winner is, that's usually when it stops being true. Right now, a battle is unfolding between Nvidia and Google in plain sight. Most major investors have already picked a side. The names are familiar and the stakes are huge, but the reasoning is flawed. Most people think that this is about chips. It's not. It's about something deeper, something most retail investors never notice and almost no one takes into account. The truth is that one of these companies could dominate the next decade. The other might be at its peak. If you're using old rules to judge this new game, you'll misread both. Most investors are losing money and they don't even know it, not because they picked the wrong stock, but because their cash is sitting idle. Moomoo isn't just today's sponsor. They're the only platform I know that actually pays you up to 8.1% just for parking your money. Moomoo is literally giving away stock from one of the most valuable companies in the world, Nvidia. Fund your account and you can get up to $1,000 in Nvidia shares. No guessing, no hoping, just free stock based on how much you deposit. It's real. It's running now, but only through my link in the description or this QR code. AI is changing the game, and Moomoo is using it the way it's supposed to be used. Instead of spending hours reading reports, watching charts, or chasing headlines, Moomoo's AI stock analysis pulls it all together in seconds. It scans everything: earnings, charts, sentiment data, and gives you the key facts you need to make smarter investments. You want edge? Moomoo gives it to you. Their next day trend projection shows where the stock might go tomorrow, visually, no guesswork. You also get free Morningstar research just for funding your account with $100. Aggregated news, institutional ownership, insider activity, short interest, technical sentiment, it's all there in one place. Robinhood doesn't do this, Webull doesn't either. If you're serious about investing, Moomoo's already playing at the level you're trying to reach. Here's what you get: up to $1,000 in free Nvidia stock, up to 8.1% APY just for parking your cash, and commission-free trading on stocks, ETFs, and options. But here's the part you need to get right. You only get this deal if you use my link or the QR code on the screen. It's running now, but only through the link in the description or this QR code. Google and Meta aren't trying to beat Nvidia. They're trying to escape it. Everyone thinks Meta is going after Nvidia. That's not accurate. The deal isn't focused on performance, it's about dependence. Meta doesn't want to beat Nvidia. They want a way out from underneath it. For years, Nvidia has controlled the stack: hardware, software, and the ecosystem. They don't just sell chips, they sell dominance. And when you're dominant, you set the price. Just look at the numbers: 73% gross margins, 41% free cash flow margin. These aren't healthy margins, they're cartel margins. If you're a hyperscaler burning tens of billions of dollars a year on AI, you see that and ask one question: how do we stop feeding this beast? Now, before your CFO starts crying about how expensive Nvidia chips are, let's do some basic math. You think you're saving money by switching to something cheaper. Congratulations, you just downgraded your entire AI stack, fractured your workflows, and lost 6 months to compatibility hell, all so you could save a few percentage points. That's called tripping over dollars to save pennies. It doesn't make you smart, it makes you the idiot that bought the budget tires for a Ferrari. That's where Google comes in. Their TPUs aren't a better product, they're a cheaper one. Meta's not switching for performance, they're switching for leverage. Renting TPUs from Google gives them a second source. Buying them in 2027 offers an escape route. But let's be clear, TPUs can't run every model. CUDA is still the foundation for AI. Nvidia's business doesn't break unless customers leave, and no one has. This isn't disruption, this is survival. Everyone wants a plan B because Nvidia's plan A is just too expensive. The bottom line, big tech isn't abandoning Nvidia. They're trying to escape its pricing power. That's not a sign of weakness. That's what total dominance looks like when it works. Nvidia's moat isn't just hardware, it's the entire stack. Most people think Nvidia's lead comes from better chips. They're wrong. The chip is the front door, but behind it, there's a fortress. CUDA is the software language AI lives on. It's the infrastructure everyone already built on top of. Every startup, every model, every training run, you don't just switch out the engine mid-race and hope nothing breaks. And here's what most people ignore. Nvidia owns the full stack. Chips, dominant. Software, locked in. Ecosystem, fully built. Demand, still exceeding the supply. The competition doesn't just have to make a faster chip. They have to rewire the entire industry to use it. That's not a swap, that's a war. Everyone's building their own chips because they want to reduce cost. That's fine, but even Google still buys Nvidia. Why? Because when it's time to run the biggest models at the fastest speeds with the least friction, Nvidia is still the default. Think of Nvidia's stack like a Formula One race car. Every part is engineered for a single goal, to win at speed. You don't just rip out the engine and slap in something else without wrecking the performance. These chips weren't designed in isolation. They were designed for each other. Dropping in someone else's silicon isn't an upgrade, it's a mismatch. You don't fine-tune your Formula One car with parts from the junkyard. That's not a knock on the other chips. Some of them might even outperform Nvidia on isolated benchmarks. But once you plug them into a system they weren't built for, those gains disappear. And that's the part most people don't understand. The bottom line, you don't just replace Nvidia by showing up with a new chip. You have to rebuild everything around it, as in the entire stack. And no one's done that yet. The moment Google and Meta announced their talks about chips, the market changed. Google shifted from background noise to front-page news. Nvidia's position, suddenly uncertain. But the focus is on the wrong issue. The world is reacting to the headlines. Almost no one is paying attention to the machine behind it. While everyone debates chips, Google has been quietly building one of the strongest AI platforms in the world, consistently and relentlessly. This isn't just a concept, it is already running at scale. Here are the numbers. Google Cloud generated $15.2 billion in one quarter with 34% growth. Cloud margins rose to 23.7% and are still increasing. Gemini processes 7 billion tokens every minute across the API. Cloud backlog has reached $155 billion. There are over 300 million paid subscriptions across YouTube Premium and Google One. Gemini has 650 million monthly active users. This is no longer just an ad business with side projects. This is a complete AI ecosystem. Silicon, models, infrastructure, distribution, everything is integrated and already making money across the platform. And here is what most people don't understand. Google is not choosing between its TPUs and Nvidia's chips. They are scaling both. Their own silicon gives them cost control, while Nvidia provides peak performance. That combination protects margins and speeds up adoption in every part of their business. The bottom line, Google is not trying to catch up. They have been building their foundation for years, and now they are taking off. Anyone still labeling them as a search company is seeing a version of Google that no longer exists. The numbers don't lie. The head-to-head financials. This is where fantasy ends and reality begins. Speculation sounds smart until you compare the numbers directly and see that the truth is much messier than it seems. Let's break it down. Profitability. Nvidia's net profit margin, 53%. Google's net profit margin, 32%. Nvidia isn't just profitable, it's highly efficient. They keep over half of every dollar in revenue. That doesn't happen in competitive markets. It only happens when you're the toll booth and everyone else pays you to move. Free cash flow. Nvidia's free cash flow margin, 41%. Google's, 19%. Both are great businesses. One is twice as efficient at turning revenue into cash. That's not a small difference. It shows operational strength. Cash return on invested capital. Nvidia, 75.3%. Google, 19%. This shows you who is turning reinvested capital into results. Nvidia is in an elite category. For every dollar they reinvest, they generate nearly 4 times the output of Google. That's effective execution. Valuation in the PE ratio. Nvidia, 44. Google, 32. At first glance, Nvidia seems expensive, but look closer and you'll see the difference in growth. Nvidia's revenue growth forecast is 63%. Google is 14%. You're not just paying for where they are, you're paying for where they are heading. If you think a 32 PE ratio is cheap for a 14% growth rate, you're betting on yesterday's Google, not today's. The Sharpe ratio and volatility by looking at the S&P 500 beta. Nvidia Sharpe ratio, 1.7. Google Sharpe ratio, 5.1. Nvidia's beta versus the S&P 500, 1.9. Google's beta versus the S&P 500, 1.1. Let's break this down. The Sharpe ratio shows how much return you get for every unit of risk. It answers a key question. Is the reward worth the risk? If you earn 20% but had to navigate a lot of volatility, that's not impressive. If you earn 20% with hardly any downturns, that is impressive. A Sharpe ratio above 3 is considered excellent. Google's 5.1, that's exceptional. Nvidia's 1.7 is still solid, but you face much more volatility to achieve it. Think of it like this. The Sharpe ratio is your efficiency score. Google is driving 100 miles on 1 gallon of gas. Nvidia is burning more gas to go faster, which works, but only if you can handle the bumps along the way. The same goes for beta. Nvidia's beta is 1.9, making it nearly twice as volatile as the S&P 500. Google's is 1.1. That means when the market fluctuates, Nvidia moves more dramatically. You gain more on the upside, but you also experience more swings. I recently added both the Sharpe ratio and the beta to my TradingView indicators, and it's a game changer. You can instantly see who delivers returns that justify the risk. If you want to give it a try, the free trial link is in the description below. Year-to-date performance, Nvidia is up 29%, Google is up 71%. While everyone focused on Nvidia, Google quietly climbed 51% over the last 3 months, even before the Google Meta deal news broke. The story is changing because the results are clear. Google didn't ride the hype, it built strength beneath the surface. The bottom line, Nvidia is the cash-generating powerhouse. Google is the king of risk-adjusted returns. One excels in margins and efficiency, while the other shows steady growth. This isn't about picking the cheaper stock. It's about understanding what type of strength matters for your portfolio. Explosive growth or steady compounding. Most investors never dig this deep, but that's where the real advantage lies. So are these long-term buys? Let's cover the bull and the bear case for each. Nvidia's bull case. Nvidia doesn't sell just GPUs. It owns the entire AI stack. This includes hardware, software, developer support, and distribution. They are growing at 63%, maintaining a 53% profit margin, and returning 75% on invested capital. Every major model trains on their pipeline. This isn't just a chip business, it's infrastructure. Nvidia's bear case. Fat margins attract competition. When you're making half of every dollar in revenue, every hyperscaler sees you as a cost problem. Meta, Google, Amazon, and Microsoft aren't trying to outdo Nvidia. They want leverage. The goal isn't about performance, it's about pricing power. The more competitive their in-house chips appear, the more pressure Nvidia faces to cut deals. This is how you weaken a competitive advantage without breaking it. Nvidia's moat is still substantial. CUDA runs everything. Switching costs are high. You can't simply replace Nvidia like RAM. But Nvidia understands that they're the Formula One car. If others start building their own tracks, being fast won't be enough. That's why they're covering all bases. They're securing the entire stack while ensuring that others still rely on it. The bottom line, if you want explosive growth and can handle volatility, Nvidia still delivers. The cash flow is real, but the competition is on the rise, aiming not to win, but to diminish. That matters if you're in it for the long haul. Now Google's bull case. Google has shifted from being a slow mover to an efficient operator. Cloud services are growing at 34%. Gemini integrates across all services. They recently gave Meta a second source chip deal that impacted Nvidia's stock. They have quietly built a significant AI infrastructure stack, including TPUs, models, deployment tools, and a vast user base. This is more than just an ad company, it's a platform. Google's bear case. A 14% revenue growth rate isn't impressive. While TPUs are getting better, they still depend on Nvidia to train models at scale. The question isn't whether they have the tools, it's whether they can deliver them at scale and attract developers away from Nvidia's stack. Currently, the answer is not clear. The Google mode is also dominant. They lead in search, YouTube, Gmail, Android, and Chrome with billions of users and petabytes of data. Now they're adding Gemini throughout their ecosystem. What they needed was more control at the chip level, and that's beginning to change. And now the dark horse angle. If Google creates a full stack AI system to compete with Nvidia's, covering chips, models, software, and cloud, it could become a two-horse race. They have the cash, the customer base, developer ecosystem, and technical expertise. The market isn't reflecting this potential, but if TPUs gain traction, everything could shift. The bottom line? Google is steadily growing with significant upside hidden behind a stable surface. It's not merely a search business anymore. It's a platform with infrastructure goals. You shouldn't chase it at this price, as it's up 71% year to date, but any pullback or sideways movement presents a buying opportunity. You're not just betting on AI growth, you're betting on them completing the stack. That's the real potential. Who wins, what I'm buying, and what you should know. Let's get a few things straight. Nvidia isn't losing. Google isn't winning, but the game just changed, and I'm not ignoring it. I'm overweight Nvidia stock and I'll be adding more Google to my portfolio. Not today, not while it's this extended, but if we get a pullback or consolidation, I'm loading up. The bottom line, I want both in my portfolio. Nvidia for the execution, Google for the upside potential. These are both long-term AI compounders and I want them working for me. Now let me ask you something. Is anyone else breaking down the Google and Meta chip deal, Nvidia's margin war, and what it actually means for your portfolio while showing you exactly how I'm building positions in real time? Who else is giving you the bull case, the bear case, and backing it with execution? Not recycled opinions. Nobody. That's why I'm up $2.21 million this year. That's why my accounts are sitting at $5.7 million and up over 63% year to date. And it's not just me. Wreaks Havoc and Jungle are locking in wins almost daily, even in this volatile market. These aren't cherry-picked. They're what happens when you stop chasing alerts and start learning how to think like a disciplined investor. Inside my Patreon, you get real-time trade alerts, every entry, every exit, every reason, daily market breakdowns, only what matters, no noise, and my daily hot stocks, the same ones I'm watching that day, plus access to the sharpest, most data-driven investor community out there. It's $30 a month. Instead of blowing that on bullshit, put $30 into something that actually makes you better. If it doesn't 3x your investment in yourself, cancel anytime. No pressure, no gimmicks. Many of my members have been with me for over 6 years. Why? Because it works. So here's the real question. Are you going to keep watching other people win, or are you ready to become the next success story? Because the truth is simple. You can scroll or you can scale. But either way, don't say you didn't have the chance to join our community and level up.